When you think about retirement, you probably picture slow mornings, road trips with your spouse, and finally being done with paychecks and deadlines. But there's one thing a lot of people overlook, and it's not inflation, it's not the market, it's taxes. The wrong combination of state taxes can quietly drain tens of thousands of dollars from your retirement every single year. Enough to make you run out of money years before you should. And most of that damage doesn't come from one big tax. It comes from 6 smaller ones stacked on top of each other. So in this video, I'll break down the 6 types of taxes that hit retirees the hardest: income, Social Security, capital gains, sales, property, and estate, state by state, with the actual numbers. If you're trying to figure out the best states to retire in 2026, this is the order you need to think in. So let's run through them one at a time, and at the end, I'll give you the 7 best and 7 worst states overall. Now, let's start with state income tax. This is the one most people look at first, and for good reason. 8 states don't tax earned income at all: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming. New Hampshire sits in a close to zero category too, and we'll come back to that. On the flip side, California still carries the highest top marginal rate at 13.3%, plus another 1.1% for state disability insurance. New York follows at 10.9%. Hawaii sits at 11%. Oregon reaches 9.9%. Those are the states that squeeze retirement paychecks the hardest. And it matters more than the headline suggests. Wage income, pension income, Social Security, and IRA withdrawals are all taxed differently from state to state. 13 states fully exempt pension and 401k withdrawals. That group includes Illinois, Iowa, Mississippi, and Pennsylvania. Alabama and Hawaii exempt pensions but still tax 401k and IRA withdrawals, which is a trap a lot of retirees miss. And I want you to feel this for a second. It's the first of the month. You open the bank app before coffee. You see the deposit land. You run the numbers in your head. You subtract the grocery bill. You subtract the utility. You subtract the property tax escrow. What's left is what your state let you keep. That's what state income tax retirement really means at 65. It's not a line on a spreadsheet. It's the size of the cushion you feel under you at breakfast. Speaking of that first of the month feeling, let's move to Social Security and pension taxes. Here's the kicker: 9 states still tax your Social Security check in 2026. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, West Virginia. West Virginia is phasing this out, with full elimination reportedly landing in 2026. The other 8 are still charging you on a benefit you already paid into for 40 years. Imagine this. You and your spouse sit at the kitchen table. On a Tuesday morning, coffee in both cups. Your spouse looks up from the tablet and says, "Honey, did you see the deposit?" You say, "Yeah, it's about $40 short of last month." You check. Same benefit amount. Same cost of living adjustment. The difference is your state. $40 a month is $480 a year. Over a 20-year retirement, that's $9,600, and that's just the Social Security slice. Now, on pensions and retirement accounts, the picture is different. 13 states fully exempt pension income for 401k withdrawals and IRA distributions. That group includes the 8 no-income tax states, plus Illinois, Iowa, Mississippi, Pennsylvania, and Washington. Trust me, if you work 30 years at a company with a real pension, these states treat you like you earned it. You've paid in for 40 years, now it's your turn to keep it. And when you picture what Social Security and pension money actually becomes: groceries, medical copays, a Christmas plane ticket for the grandkids, the state you live in decides how many of those things you still get. Now, on the flip side of income tax, there's a quieter category most retirees forget: capital gains. This one hits when you sell a stock, a rental property, a long-held brokerage position, or a small business you built. The 8 no-income tax states generally don't touch capital gains either: Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, Wyoming. Well, almost. Washington now taxes long-term capital gains above a threshold, so it no longer belongs in the Pure Zero Club. Take Missouri, for example. Missouri eliminated its state capital gains tax in January 2025, which makes it one of the quiet winners for anyone planning to sell a long-time asset. On the other side, California still taxes long-term gains as ordinary income at that 13.3% top rate. New Jersey reaches 10.75%. Oregon hits 9.9%. For a retiree selling a rental property with a $300,000 long-term gain, the state-level tax difference between Missouri and California is roughly $39,900. Same asset, same year, different state. And here's the part most retirees don't plan for. If you're running Roth conversions in your 60s to reduce required minimum distributions later, the state you live in during those conversion years matters enormously. A 5-year conversion done in a no-income tax state can keep tens of thousands inside your own account that would otherwise head straight to Sacramento or Albany. Saving even 1% on your effective tax rate on a $60,000 income is $600 a year. Over 20 years, that's $12,000. That's a cruise. That's a grandchild's first semester. Small percentages turn into real memories. First, I'd like to take a quick moment. If this is helpful, tap like and drop a comment with the state you're thinking about. It really does help the algorithm get this in front of more people planning their retirement. Now, let's move on to sales tax. 5 states push their combined state and local sales tax above 9%. Louisiana, Tennessee, Arkansas, Washington, Alabama. Take Tennessee, for example. The combined average rate hits 9.56% on $40,000 of annual taxable spending, which is normal for a retired couple once you include appliances, restaurants, and car repairs. That's roughly $3,824 a year. Every year. Trust me, retired couples feel that at the grocery register. On the flip side, for states charge no state sales tax at all. Delaware, Montana, New Hampshire, Oregon. Alaska has no state sales tax either, though local jurisdictions average about 1.8%. Speaking of big purchases, here's the kicker: sales tax isn't just about daily spending. On a $50,000 new vehicle, the sales tax difference between Oregon and Tennessee is roughly $4,780 on a single transaction. Same car, same day, different state line. For someone over 50 who downsizes, a lot of one-time spending happens in the first 2 years after moving. New furniture, a newer car, appliances for the smaller house, landscaping, all of it flows through sales tax. So a state that looks friendly on income can quietly bite on the setup phase of retirement. And sales tax interacts with groceries in ways people miss. Tennessee taxes groceries at 4%, with local add-ons on top. Alabama taxes them too, though it's phasing that down. Kansas is unwinding its grocery sales tax as well. Meanwhile, most no-sales tax states obviously don't, and many other states exempt groceries entirely. So when you look at sales tax, look at groceries separately from general retail. It changes the math for anyone cooking at home, which at 65 is most of us. Now let's move on to property tax. According to the Census Bureau, the average American household pays $2,969 a year in property taxes. But that average hides huge differences. Property taxes are set locally, and home prices swing the real bill even more than rates do. Hawaii has the lowest effective rate in the country, but the median home sits above $800,000, which pushes the average bill past $8,000 a year. Alabama has the second lowest rate, but the median home is under $200,000, so the average bill lands closer to $700. On the flip side, the states with the highest effective property tax rates are New Jersey, Illinois, Connecticut, New Hampshire, and Vermont. New Jersey's effective rate sits at roughly 2.23%. Illinois is around 2.08%. Connecticut is about 1.79%. On a $400,000 home in New Jersey, that's about $8,920 a year every single year. When you factor in both rate and home prices, the 8 states with the lowest total property tax burden are Alabama, West Virginia, Arkansas, Louisiana, Mississippi, South Carolina, Tennessee, and Kentucky. The 8 worst are New Jersey, Connecticut, New Hampshire, New York, Massachusetts, Illinois, Vermont, and California. Those high property tax states also rank near the top on rent, which matters if you're not buying. So the real question isn't just, does my state tax my income? is what's my total tax bill going to look like? Property tax is the line that doesn't move when your income drops in retirement. Your paycheck ends. Your property tax does not. Trust me, that's the line item that catches people when they're 72. And living on Social Security plus a modest IRA. A quick word on 3 retiree favorites that live at the intersection of all these categories. Florida is still the classic warm year-round, developed retiree communities from the villages to Naples to Sarasota, and no state income tax. The catch is Florida homeowners insurance, which for many standard single-family homes now runs $4,200 to $7,100 a year, and in some coastal zip codes significantly more. Tennessee is the balanced pick: Smoky Mountains in the east, Nashville in the middle, Memphis in the west, below average cost of living, and no state tax on Social Security, pensions, or retirement accounts. The sales tax sits at 9.56% combined, which is real money at the register. Texas is the healthcare pick. The Texas Medical Center in Houston is the largest medical complex in the world, and Dallas, Austin, and San Antonio all carry top hospital systems. No state income tax, but the property tax runs 1.60% to 1.90%, which on a $400,000 home is $6,400 to $7,600 a year, every year. Now, let's move on to estate and inheritance taxes. Federally, most retirees are clear. Starting in 2026, the estate tax exemption is $15 million for individuals and $30 million for couples. Almost nobody crosses that line. But state-level estate and inheritance taxes hit much lower thresholds, and they can cost your family real money. Here's the kicker: the threshold for estate tax often starts at $1 million, not $15 million. 5 states charge an inheritance tax, paid by the person receiving the money: Kentucky, Maryland, Nebraska, New Jersey, Pennsylvania. Rates can reach 16%, depending on how closely related the heir is. 12 states plus the District of Columbia charge an estate tax, paid out of the estate before heirs see a dollar. Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, Washington. Maryland charges both. Take Oregon for example. Estates over $1 million get hit 10 to 16%. On a $3 million estate, that's roughly $250,000 out before the next generation sees any of it. That's a house down payment for a grandchild. That's a small business seed. You spent 40 years building something. The question isn't just how much the IRS takes from you. It's how much actually reaches the next generation. Trust me, the headline number lies. The total picture tells the truth. That's the frame you need for the best states to retire in 2026. Income, Social Security, capital gains, sales, property, and estate stacked together. That's the real retirement tax by state 2026 picture. Not one line, 6 lines, based on a combined look at those 6 categories. 7 tax-friendly states for retirees 2026 consistently rank at the top: Alaska, Florida, Georgia, Mississippi, Nevada, South Dakota, Wyoming. No income tax in most. Generous treatment of pension and Social Security income. Modest estate exposure. On the flip side, 7 states rank as the worst states to retire taxes-wise: California, Connecticut, Maine, Minnesota, Nebraska, Rhode Island, Vermont. High state income tax retirement exposure. Continued taxation of Social Security in several. Active estate taxes in most. Here's where you come in. Your situation is specific. If you're doing large Roth conversions, state income tax matters most. In the conversion years, if you're pulling from a pension exemption matters more than sales tax. If your net worth is concentrated in real estate, property tax and estate tax dominate. If most of your spending is groceries and utilities at a fixed volume, sales tax moves the needle less than people assume. So build your own stack. 6 categories. Your numbers. Your life. And one more thing. Taxes aren't the only factor. Proximity to family, climate, access to specialists, friends, faith community, all of that matters. Taxes just decide how much of your money you actually keep while you enjoy the rest. As always, run your numbers with a CPA before you make a move. If this video helped clarify the best states to retire in 2026 for you, hit the like button and share it with someone you love who's quietly planning their next chapter. Thank you for watching, and I'll see you in the next one.